Tonight, I'm Mark Taylor. I'll be teaching the class. And the first thing I'm going to do is jump into the syllabus. Let's go over that. All the usual information on here you guys are used to seeing. Textbook, you can get any form of the textbook you want. You do not need to get the Connect Access. It isn't wrong if you have it, but it's not necessary. Let's see here. You can read through that. Okay, this is the part that is somewhat important. I think I'll just highlight it. How about there's assignments we do in class, and textbook problems are 20% of the course grade, and their exams are 80%. Assignments and textbook problem are assigned for each chapter. Assignments are emailed to students and are also available in Blackboard. The exams are only emailed. So if you're looking for an exam, look in your email, it'll be there. And as far as submitting work, all assignments need to be submitted in Blackboard, as you might guess. Assignments are usually done 1 week after they are assigned. And this is an important one. That late work is accepted without penalty. However, the grade will show a 0 until the missing work is turned in. So your grade will look bad until you turn it in, but you can still turn stuff in late. So just because the due date goes by, don't think, oh, I can't turn it in, I missed the due date. You can, and you get full credit for it, but your grade's going to look, bad until you do turn it in. Okay, course info. Hopefully you don't need to drop it. If you do, there's we already talked about this. And there's our beloved grading scale. And for most of these, you'll notice going down here, so this is the course by week. And for most of it going down here, you'll see that after 1 chapter, sometimes 2, we have an exam. And that's because generally people do better that way. It's just it's just a better way to do it. People usually do better and they retain more. Here's an important note, though. Next week, no class. I'm having hip surgery.
Oh, that's a big one. Hopefully it goes well.
You don't hear that as an excuse very often, but yeah. Yeah, so I'm having hip surgery next Tuesday, and so by the way, even if you email me, I'm probably not going to get back to you. And if you call my phone, you're going to probably get my son. So anyway, next week we're just not going to have there's not going to be class next week. And we'll go through the stuff today. We're going to go through today, and we'll pick it up on week 3. So just make a note of that. That next week you no class. And so this is pretty much the class, what it's going to be. And again, usually after most of them are going to have an exam after each chapter. Chapter 2 and 3 are combined together. It's really just chapter 3, to be honest with you. Chapter 3 is the big one in there. Yeah. So they're mostly just 1 chapter. This one down here is 3, but it's mostly the first one here, chapter 16. So anyway. We will not have class on Thursday. Also, correct. So Thursday class is tomorrow's class for accounting 430 is. We also won't have class for that one. So I'll just start week 3. Now we will have class if you have the accounting. Yeah, I'm all blurry. Well, it's not gonna refocus. It's not liking me for some reason. And accounting 330, we will have class on Monday because my surgery's on Tuesday. So we will have the Monday class. So accounting 330, unfortunately, does not get the the hip surgery week-long break from accounting. So if you do have accounting 330, I will be there for Monday. Okay. Any questions on this? All right, now as far as turning things in, if you go into Blackboard, zoom in a little bit here, oops. Assignments and work submittal. Too big. You'll notice that when it comes to the assignments, well, it just goes over what I just talked about, that assignments are emailed. Textbook problems are in the textbook, obviously. Exams are emailed. And down here, this is how you turn things in. It'll have the handouts that we usually have. In this case, it's the chapter 1 handout, the assignment. And then here's where you click on it to turn it in when it's done. Now, say, well, how do I turn it in? Well, you can either complete the original document, so the document that I sent out or that you downloaded here, you can complete it in the document itself and turn the document in. You can complete by hand and scan it, or if you do work in a notebook, you can just scan that. Or you can take multiple pictures. So if you have a 10-page handout or 10 pages of notes, you can take pictures of them and turn in those 10 pictures. You can turn in as many files as you want. These are unlimited. Well, here, I'll show you. Oh, wait a minute. Hey. This is how we set them up. And they're unlimited attempts. So you can turn in 10 files into the assignments. So you can turn in 10 pictures. Now, things you can't turn in: zip files and page files. Zip files are for Windows, page files are in Apple. So if you take 10 pictures, don't put them into a zip file or a page file. Just turn in the pictures separately. Blackboard doesn't like them. I wish they did, but they don't. And so, down here is where you turn those in. Any questions on that? Okay. Well, if you have any questions, let me know and we'll be happy to go over them. I messed up my computer. Okay. So let's jump right into the handout. Is there anyone that does not have the handout? Anyone that didn't get it in the email? If you didn't get it in the email, it's in Blackboard too. Okay. We're going to talk about the equity method. We're also going to talk about just kind of how we split up the accounts and what they are, kind of classifying them. This is one of those things that like on the CPA exam, they get into this pretty heavily. Now, in this class, we're mostly going to concentrate on these two down here. But we kind of have to know about these other ones to know why we do the accounting the way we do it down here. Okay. So let's go through the different types of investment. So basically, for the most part, the stocks are broken up into investing in stocks and bonds. So bonds are usually called their debt securities, and equity securities are usually stock. So stocks and bonds. And possible categories. Held to maturity. That's when you hold an investment until it matures. So if it's a 5-year bond, you're going to hold it for 5 years. Trading securities, debt securities, they can be sold at any time. And these are current assets. because they could be sold today. Okay. So very short term. And available for sale, and this still has unrealized gains and losses, which they kind of did away with for most stuff, and they may do away with it for this too. But that's kind of wacky, and we're not going to get into it in this class, but they do have that category. Now, you'll notice that there are some categories that are not available to bonds. And this is because they're based on how much ownership you have. And if you buy bonds, you're not buying ownership. You know, if you want to have ownership, that you're going to actually have a voting right, all that kind of stuff for you have to buy stock. So buying bonds, so these securities that have to do with ownership, those don't apply to bonds, because if you buy a bond, you know, if I buy an IBM bond, I have no voting rights, you know, to run the company or anything like that. So there is no ownership of it. I just own the bond. I own it's basically a debt that they owe me, and but I have no control over it. So any investment that is based on control doesn't apply to that investment of bonds. Okay, so coming down here, equity security, and notice that these are kind of broken up into based on how much influence they have, either non-influential, influential, or controlling. And so here's the ownership interest. And you'll notice they don't have things like held to maturity because stocks never mature. Okay, and now here is where it gets a little bit wacky. Maybe a lot of it wacky. The true test as far as which one of these categories they go into is based on whether they are influential or not influential. So if they're non-influential, it's fair value. If it's influential, then it's the equity method. These breakups of ownership are not really in the rules. And so this is kind of a weird thing that happened. When they released these categories, they gave examples that between 0 and 20% were non-influential, and between 20 and 50% were influential. In the United States, we kind of go by, you know, we're very specific in rules. We don't go by general rules a lot of time. So those kind of stuck. And so the basic rules are that if it's 0 to 20%, unless someone says otherwise, it's non-influential. And if it's 20 to 50% ownership, it is influential, unless you know otherwise. Now, it is possible that you do know otherwise. For instance, if you own 10% of General Motors, you'd be very influential. You probably have 2 or 3 people on the board of directors. So it is possible that you are below or above those, you know, those designations, and you know, and you go back to the true nature of it is, if it's non-influential, it's the fair value method. If it is influential, then it's the equity method. So it really is based on those 2 criteria. If you don't know, then you go back to the percentages. So it's kind of a weird thing that the influential, non-influential is the overriding, but if you don't know that, then you can fall back on the 20% cutoff. Kind of strange, but that's where we're at. Okay. So let's do some of these multiple choice questions on what we just talked about. So debt securities, these are bonds. Oops. Let's try that again. There we go, bonds. Purchased a 5-year treasury bond as an investment. Management intends to hold the bonds for the entire 5-year life. What method would you use?
Held to maturity.
Yep. Very good. Yep. Purchased a 5-year treasury bond as an investment. Management intends to hold this investment for 2 years. Which method?
Available for sale.
Yep. Purchase treasury bond as an investment. Management intends to sell the bonds within the next month.
Trading.
Trading. Yep. And notice that the equity method is not going to be available. They don't own it. There's no ownership. Okay, equity securities. First 1,000 shares of General Motors stock as an investment. Management intends to hold this investment forever.
Fair
Is
value.
it equity?
Probably be fair. I don't know how many shares of stock General Motors has, but it's probably quite a few. It'd probably be fair value. Now, if they didn't have that many shares of stock outstanding, then it would be, it could be an equity. But my guess is this is not influential. 1,000. Purchase General Motors stock as an investment. Manager hold this stock for 3 years.
Would it still be fair value?
Yep. And General Motors, back in it says to find us next payroll.
Fair value.
Fair value, yep. So if it's not influential, and by the way, this is kind of a new category, the fair value category. If it's not influential, it's just going to be in fair value. We used to have it. You could also be in the trading securities, but we don't do that anymore. If you're wondering why, why is it the same answer for all of them? That's why it's not available to them anymore. It's the trading securities are only available to debt securities. Okay, equity securities. Purchase 25% of LiveGo as an investment. Management intends to hold this for at least 3 years.
Equity method.
Yep. Yeah, they don't tell us whether it's influential or not. So then we have to kind of fall back on that 20% cutoff line. All right. Purchase 25% of the stock as an investment. Management intends to hold this for at least 3 years. The other 75% of the stock is held by the founder of LiveGo. Okay, this is a little bit tricky. And the question is, are they influential or non-influential? They own 25% of it, but somebody else owns one other person owns 75% of it.
It's still the equity method, though. It's not.
Well, it could be, or if it depends if they're influential or not. But if there's only one out there, it very well could be a fair value. The reason being is that you can be voted down every single time, whatever the 75% goes. Now, if this was split up among 50 other investors, you may very well say that that it's equity method. But if there's just one group out there that or one holding entity out there, in this case, the person, the founder, it could very well be that you're not influential. So even if you own 25%, it's possible that it would be influential. Purchase 60% of the outstanding shares of General General Industrial common stock as an investment. Management intends to hold this for 2 years.
Easy
Consolidation.
consolidation.
Yep, very good. By the way, we will find out that the consolidation, the equity method is actually used in the consolidation. So these two, even though they're separate, well, I'll talk about the difference a little bit here, but the consolidation actually uses the equity method. I'll tell you what the difference is. Purchase 10% of the outstanding shares of General Motors stock as an investment. Management intends to hold this for 2 years. Management has 2 officials on the board of directors.
Equity method.
Yep. Yeah, if you got somebody on the board of directors, you're influential. Purchase 30% of the outstanding shares of Ford Motor Company stock as an investment, but only acquired 4% of the voting rights. Management intends to hold this investment for 7 years.
Equity.
Most likely, it's going to be
Fair value.
fair value. Yeah. Now, if they hit somebody on the board of directors,
Okay.
if they give no, but in the if they gave that information that they had somebody on the board of directors, which you'd have to think they almost would. So the equity method isn't a bad idea, but 4% of voting rights is generally not going to be considered influential. Oh, like I say, unless they have, say, someone on the board of directors or something like that. And by the way, Ford Motor Company, you guys don't know if you guys know this or not, but the Ford family owns a lot of the voting rights. You can buy Ford stock, but there's 2 different kinds of stock. There's like family stock that has all the voting rights, and then there's everybody else. So that's kind of a, you'll find situations like that, you know, the stock that you can buy is a lot of times has fewer votes than some other ones. Okay, purchase 30% of the shares of Peabody stock as a short-term investment. Management intends to sell the investment when the stock price reaches $80 per share.
Equity.
Yep. Yeah, and now you look at it and go, wait a minute, they're trying to get rid of this, right? I mean, the second the stock gets 80 a share, they're getting out. But it's these categories are simply based on influential, and unless you know otherwise, 30% is above that 20% rule. Okay. The equity method. What is it? Oh, well, first of all, I want to talk about the equity method in consolidations. The equity method is the investment is set, it's by itself as a regular investment on their books. Consolidations, they actually take the 2 companies' financial statements and kind of smush them together. So if it's just the equity method, you know, if it's just you're just using the equity method, is you know, 50% non-controlling, you know, but influential. You'll carry it as an investment. It's an investment on your books. If you own more than 50%, if you're controlling, then you will take your financial statements and their financial statements and we'll smush them together. And we'll see how to do that in chapters 2 and 3, where you take both companies and combine them. You know, put them together and make them into one consolidated financial statements. So for instance, a company like Ford Motor Company, they'll have the Ford Motor Company financial statements. And then they'll also have what they call consolidated financial statements, where they take all of their other companies that they control and they all put them all together into consolidated financial statements. So anytime you have 50% or more, I should say more than 50% actually, then you're controlling, then you do consolidated. Now, here's the weird thing is that throughout the year, even if you're doing consolidations, you'll carry that on the books as an investment. And then at the end of the year, you take it out of the investment account and make them into big financial statements. But So you actually use the equity method for both of them. Now, the equity method is when you own so much of a company that the ideas of income become a little bit different. For instance, if you buy, 100 shares of IBM stock, IBM pays a dividend. You count that as dividend income or dividend revenue, right? It's money coming in. Now, at some point, though, if you own enough of the company, it doesn't really matter things like dividends. For instance, let's say that this is going to be confusing. It's like looking in a mirror. That your company A is the parent and company B is what they're investing in. Okay, oops, hold on a second. Okay, so company B is what they're investing in. So they own 100%, let's say, of both of them. So company A owns 100% of B. So, okay, they own 100%. Now, company B, there's a quarter. Company B just paid A a quarter. How much wealthier am I if I own both of these?
You're not.
I'm not. Right. All you can say is that, okay, company B is worth 25 cents less, and company A, and this will have 25 cents more. But I'm not any wealthier if I own both of them. So that's the whole idea behind equity. It's when you own so much of the other business that things like dividends are not, you don't jump up and down and say, yay, that's money coming in. You just say, okay, that's just transferring money from one asset to another asset. I'm not any better off than I am. How do they make money? They make money the same way that company A makes money. If you have net income, that's how you make money, through net income, not through things like dividends. So it's when you own so much of a company that things like dividends going between the companies really don't matter. Okay. So coming down here to rules. All right. Mostly we're going to concentrate on the first two here when we go through it. And that is the equity method. Investment income comes from net income or net loss, hopefully net income. And then we also have, we can have excess depreciation, which we'll talk about in a little bit. Okay, balance sheet, the investment account. We're at cost, plus or minus income, amortization of excess. We'll talk about that in a second. Comprehensive income item, we're not going to do that. We could, but we're not going to. And notice that dividends received will reduce that investment account. That's kind of like what I just showed you, that if you take 25 cents out of your investment as dividends, you're not any better off. You got 25 cents, but your investment's now worth 25 cents less. Okay. We'll skip over that. Equity method investments are long-term assets, so they are not current assets. If they're blah, blah, blah. Okay. All right, let's do journal entries. So this is on page 5. And we'll see what they are. Okay, so January 1st, Franco Corporation was purchased. 3% of Franco Corporation was purchased for $35,000. Okay, so one. Don't have a year. So we will have investment. I'm going to make these capital just so you can see them in there. Actually, I'm going to bold these too. 35,000. And we probably used cash. By the way, I do have the debits and credits things. You guys, I don't know if you guys need those or not, but down here at the end, the debits and credits. So basically, the investment is an asset. It's going to increase with a debit. Cash is an asset. It's going to decrease with a credit. So there's an asset going up. This is an asset going down. You don't need to put that in there. Okay, so they bought 3% of Franco Corporation. Franco Corporation paid total dividends of $5,000. Excuse me, I just bored myself. Okay, so $5,000. Now, that's for all of the shareholders. So how much of that are we going to get?
30% of this, so what
Yep.
is it? 1,600 or something?
Yeah. So 5,000 times. Oops. It's 1,500. So, hey, how come those aren't centered? Okay, so they're going to give us cash. It's going to be an asset going up. Now, we're also going to have something going down. We're going to have an asset going down.
Investment account, the equity that we just debited.
Yep, very good. So this investment account, this is our asset going down. Again, we're not any better off or worse off than we were before. Yeah, our cash went up, that's an asset. Our investment went down, it's an asset. Okay. Franco reported net income of 20,000. Okay, so how much of income are we going to? What's going to be our share of it?
It'd be 30%.
Yeah,
Yeah.
it's gonna be like 20 grand times 30%, could be like 6,000.
Maybe lazy and copy it here. So this is what, 20,000. Oops, let's take that. Yeah, you said 6,000.
Yep.
Okay. So now our investment is just going up by $6,000. It made $6,000. I had to put a date here. I didn't put a date here either. What am I doing? I was showing you guys how to be a bad account. So take note of that and don't be a bad account like me. All right, so this is a 1231. All right, so our investment account is going to go up. They just made $6,000 for us. And this is technically this is a weird account. I mean, I'm just gonna say just put it on investment income. The account that they'll use a lot of times is called equity in an income of investment or something like that. But if you just put investment income is fine. And this is sort of like a revenue account, money coming in. See something real quick. I know I just put it investment income or loss. So investment income, and it's kind of like a revenue. And so if you come down here, even though we do have decreases, generally revenues and expenses are only they only increase. So if it's a revenue, it's going to be a credit. Firstly, always, unless there's a mistake or something, it's firstly always going to be. So this will be a credit, money coming in, credit. Oops. So much space in between these. Okay. What's the ending balance in the investment account? Okay, so we have $35,000. Dividends decreased it. And investment income increased it. You can also do the T accounts too. You can do that way also. So our ending investment account will be was that 39?
39,500.
Thank you. Well, this will be our ending balance. And again, you'll notice that it's sort of like what we have when we for our just our regular financial accounting, that dividends, we subtract out retained earnings and we add in the income. It's the same thing. Okay. I'll be quiet and see if you can figure out number 6.
Well, number 6 will be the same as number 1, right? We're gonna have investment equity debit and cash credit for 80,000.
Correct. Yep. Okay, I think that what you should have gotten. Any question on that thing?
No, all good from my end.
Okay,
Yeah,
All right.
good as well.
Yeah, I got it as well.
what we're gonna do next is kind of set up for, when a company buys out another company, oftentimes the assets are, excuse me, the assets are understated often. And oops, that's not me. That's not me. The eyes are different. Okay, so so a lot of times when we buy another company, the assets are understated, and there's a reason for that. We put things on the books at historical cost. So a lot of times, especially things that are long-term, things like, plant, property, equipment, land, building, all that kind of stuff, they're understated. Someone may have bought a building in 1972 for $80,000, and maybe now it's worth 8 million, but it's on their books at $80,000. So oftentimes when you make an investment, the investment is actually worth, a big chunk of it is because these assets are undervalued. Now, when you buy an asset from somebody, you put it on the books for what you paid for it at fair value. Well, that triggers something else. They're depreciating an $80,000 building, whereas you might be depreciating an $8 million building. And that's going to cause a lot more expenses because really, you have an $8 million asset that's throwing off income, that an $8 million asset would. Maybe it's throwing out a couple $100,000. It might be having more income come in than it's even on the books for. So, you have to make that adjustment for those larger expenses because you're actually buying it in today's fair value, not jumping in the time machine, going back to 1972 and buying it. Okay. So Tom owns a restaurant. Tom buys an oven from Sarah for $700 cash on January 23rd. The oven had a carry value on Sarah's books of $460. Per the journal entries for Tom's purchase of the oven. Okay, so Tom purchased this oven, and apparently the fair value of that oven was $700. So probably put on the books as equipment. You could put in there, it was an oven. Asset going up for 700. It doesn't matter what Sarah had on her books for. Sorry about that, guys. I keep sneezing. That's what my allergies. Okay, and so what Tom paid cash. Okay, so cash, an asset going down for 700. So Tom just bought the oven. Okay, prepare the journal entry for the depreciation of the oven on December 1st. Assume the oven has an estimated useful life of 10 years with no residual value. Straight line method is used. Okay, so 10 years. So we're going to take $700. And we're going to divide it by 10 years equals $70 per year. I'm going to abbreviate. Nah. Okay, so our journal entries look like this. You remember the journal entry for depreciation is you use the morbid DE A B dead. The end of his life is dead. This would be depreciation
Expense.
expense. Yep. And accumulated depreciation. $70. So every year Tom's going to write off $70 of the oven to allocate it, allocate the $700 cost over 10 years, and it's going to be $70 per year. Now, assume the same oven, what would happen if Sarah kept the oven? If Sarah kept the oven, what would the depreciation be? Okay, well, Sarah kept the oven, the depreciation would be was she on the books for 460? Yeah. So Sarah had it on the books at 460. So it'd be what, 46 per year? So what would be the incremental impact of the expenses? So the difference between those two some number
24.
24. Thank you. So here's the kind of what I'm getting at. Notice instead of buying the oven that Tom bought, Sarah's whole place. Now on Sarah's books, if she was keeping the books herself, and she would still be depreciating it, she would have 46 in her depreciation expense because they'll be running the company the same as it was before. If we were to buy it, it would have been $70 per year. So this 24, we'd have to add an additional 24. This would be the additional depreciation. Oops. Take off the caps. Have to be added on to the depreciation because really this is a more expensive asset than Sarah has it on her books. She has it on her books for 460. It's really worth 700. So we would have to have an additional $24 of depreciation.
So, Professor, I have a question here.
Yeah.
So, if this is like a live example, and an asset's fair market value went up, this change going to be going forward, not like going back and adjust the depreciation for years past, right?
Exactly.
Okay.
Going forward.
Yep. Thank you.
And at some point, it's going to end. After 10 years, this oven's going to be gone either way. So, okay. Now,
Professor, with the 24, you say you got to add that additional depreciation. So will we make it then be 114?
no. What I was trying to compare, and I don't think I did a very good job here, is that if instead of buying the oven, we bought out Sarah's company.
Uh-huh.
Now, if Sarah keeps running the company the same way she's always been, she's going to be depreciating $460. So if she's still running the company, and she'll give the financial statements to us, but she'll be depreciating based on 460. However, when we bought it out, we buy them out at the market rates, which in this case is 700.
Mm-hmm.
We have to depreciate it at the higher rate.
Right.
So if we bought out her entire bakery or whatever it is.
You're just saying that we have an additional depreciation, but we don't do nothing. You're just saying it's a difference of 24. the
Correct. Correct.
Oh, okay. All right.
And now, if well, I think maybe we get to the problem here. You kind of
Okay, all right.
right down here.
Okay.
So let's take a look at this. So this is kind of the everything together.
Okay.
Oh, let's not do that. All right. So they bought 25% interest in Calhoun, and they have significant influence. Okay, so this is going to be equity method. Okay. Net income of 30,000 and okay, so they bought 25% of the company on January 1st for 55. Okay, so when we buy something out, we use the fair values. You know, the carry values are what they had in the past. And for some things they might be the same, or even they may be less, but for some things they might be higher. In this case, we have a building that's a little bit higher here. Okay, so let's see what the fair value of these assets are. 410. You may want to check it. Let's see my
Yes, 410.
Okay, so it's 410, and then down here I think it's the same, right? 50. Yeah, it must be. Okay, now we talk about net assets. And net assets, they could be at the carry value or the fair value. In our case, we're going to think about them as at the fair value. So net assets are basically just what the equity section would be. So if they had 370,000 for the assets and liabilities were 190, that means the net equity was what, 180? I think that's right. And then over, oops, what am I doing? The wrong key. Over here, 410 minus 190.
220.
220.
Mhm.
Thank you.
Sure.
Okay, now you can kind of see where that 55,000 comes in. Right? They bought 25% of it. So if they bought 25% of these net assets, that equals 55,000. I mean, that's where that's where the purchase price came in. Okay, so let's go through here and put all the stuff we know already on the books, and then we'll figure out what to do with this thing. Oops. All right, so let's see, the date, give me a date, January 1st. Okay, so we have an investment in our equity for 55,000. Oops. Capitalize that. So this is just like we did before. And we pay cash. That's it going down, 55,000. Calhoun had net income of 30,000. Now we get 25% of that. Actually, I think we'll do the dividend. We did dividends first last time. I'll do dividends first this time. A lot of times dividends come throughout the year. A lot of times dividends will be recorded sooner. In this case, they're both at the end of the year, but I'm gonna put dividends first. Just that quick, I forgot what the dividends were, 12,000. Okay. $3,000. So this will be. And then we'll do the same thing for the income. Well, not same thing, but the same. We did before. That's 62. Yeah. Okay. All right, so this will be.
I have a question. I'm sorry to bother you. Where do we take 25,000? It says 30,000, I think, right? The net income?
Oh, you're right. I'm sorry.
Okay. I was not sure if I'm looking at different place. Thank you.
Thank you. 30,000. So what's this, 7,500 then?
Yes.
Okay. Okay, I tell you what, let's stop here and take a break, and we'll come back and do this one. We'll do this when we come back from break. Move these up a little bit so you can see them. Okay, so let's say be back. What time is it? 7:05. Let's say 7:15. And if you want to try to kind of work ahead, try to figure out what we're going to do with this. This building in total is 40,000 more than it's on the book. So when we make our investment, we're making our investment based on this building being 240,000. How much additional depreciation expense are we going to need? And the building has a useful life of 5 years. Okay, so let's go ahead and take a break. We'll be back at this, and then we'll kind of go over that.
I will do. Thank you so much.
Huh?
I will do.
Okay,
Thank you.
so we'll be right back. Okay, do anyone think they came up with what the with the additional depreciation we're gonna need? What am I doing here? Yes, okay. All right, well. So. And so the excess here would be 40,000. Okay, now what would be our share of the excess?
$10,000.
Yeah, so we're gonna take 25%.
Yep.
Of
Mhm.
So let's see, oops, where am I at? So we bought we paid an extra $10,000. So of this 55,000, 10,000 of it went for that excess on that building. All right. So coming down here. The excess. Divided by 5 years.
Hmm. Yeah, 2,000. Yep.
I'm just gonna believe this excess. Okay, so we come to the journal entry. Now it's gonna be a little tricky. What do you think the journal entry is gonna look like for that? And I'll give you a hint that we're still only using the same accounts that we have up above here. It's gonna come out of these accounts. Anyone?
Will it be coming from the investment equity?
Yes, very good. So we're gonna reduce we're gonna basically reverse out from here. 2,000 of it, right? So you're right, it's gonna come out of the investment equity. I'm not doing very well with my cap box key today. So reducing, because notice that our share of it's 10,000, but we have to write off 2,000 of that. So we're gonna take it out of ours for 2,000. And we're gonna reduce our investment income by 2,000. So really our investment income for this would be what, 5,500? Difference between these two? Question on that? All right, let's do the next one here and I want to see, I can't remember if I made this one. Yeah, I'll kind of walk through this a little bit with you just to see what is that. The equipment is worth 50,000 more, so it's 370. I can't remember if this one has goodwill on it. I don't think it does, but let me. Oops. Yeah, that does come out, right? Maybe. Yeah, okay. Okay, so yeah, see if you can figure this one out. Okay, these are the first three. These two 30,000s are just, that's an unhappy coincidence. I'll change that the next time, but anyway. Yeah, so now we come up here to this excess. Did you wouldn't get the additional expense?
Should be like 5,000.
1,000.
Yeah, you think you're right. It isn't.
Taking the
Okay,
excess. Mhm.
So this is 50,000, and then our share of it was 30%. Yep, very good. Yeah, so our share is 15,000, so this would be the our share of it. And it's got additional life 3 years. So for the next 3 years, we're gonna tack this journal entry onto it. Knock down the investment income by 5,000. Whoa, too much there. Whoa. And take it out of the investment.
Can I please ask you how we get the excess? I think I missed it for the first question probably as
Okay.
well. The 50,000?
Yeah, we put this in here and then I'll go right up to it. It's a difference between these two.
Okay. And then we use the ownership. Mm-hmm.
Yeah, exactly. Yep. Yeah, so this is, you know, when we buy this company, and the people who, you know, we're buying in, they're not idiots. They know what the fair value is. And so there's this extra amount of money that these are worth. These are worth $50,000 more. And if we're buying 30% of it, basically we're buying 30% of, you know, that additional amount. And that 15,000 is actually included in, and it has to be, right? It has to be included in the it's included in that 57,000. Now it's going to go away though over 3 years. So that's why we're doing this down here. Over the next 3 years, it's going to go away. And so we're going to have to take it out of our investment account over the next 3 years and take it out of our income. Now, after 3 years, we don't do that anymore.
Okay, understand. Thank you.
Good. Okay. Let's see here. Two or three. We have 2 more. Okay. This one is similar to what they have in one of the book problems, I think. Now, this one's a little bit tricky in that these are they only are giving us the amounts that we paid for it. So it's our we don't have this isn't for the entire company, it's only for our 25%. So about 25% in for 300,000, that's easy. The stock, the book value of the stock purchase was 260. So it's kind of like what we did up here. You know, it's like saying, okay, the book value was 260, but it's but ours is 300. But they're really telling it from the 30% point of view. So we're going to take the 300. We're going to take the excess is going to be the 300 minus the 260, and that's going to be due to a patent. And that is, it's already in the 25%, so we don't have to do any adjustment, the 25% adjustment to it. Because it says the book value of the stock purchased was 260. So they've already done the, you know, the 25% thing. Maybe we can see what the entire company's worth. You just, you know, take the 300,000 divided by the 25%, you come with a total. Now these, the net income of 100,000 and the dividends of 60,000, that we are going to take the 25% of those. Okay. Very similar to what we just did. The only difference here is that they've already taken they've already done the 25% for us to get the excess. It's one of those things that when someone tries to simplify something, sometimes it makes it more, more complex, but. It's, okay, and the last one will be. Actually, it's already in. It'd be the 260 minus the 300,000. I said that wrong. 300,000 minus the 260. And the patent will have a life of 10 years. Oops. Okay, I want to point out something really kind of unusual about the equity account journal entries. You may have picked up on this already. It's a little bit strange. And it's only for this kind of account. You'll notice that every single journal entry has the investment account in it. So when you're doing the equity method, the equity investment account is in every single journal entry. So what you really, if you're questioning whether what accounts to use, you're really only looking for one. What's the one other account? Because investment equity is going to be in there one way or another for all of these. So that's kind of a weird. It's a little bit of a weird side note to this, but the investments accounts in every single one of them. Okay, I think I'm going to give you guys this. This will be for homework, and then you can turn the whole thing in. And I think the due date is, you got 2 weeks or more, a little more than 2 weeks to turn it in. And remember, no class next week. So do page 11. Yeah, I'm sure you guys do fine with it. And then you can just turn the whole thing in, and you go ahead and submit it in Blackboard in here. You know, local file, however you want to do it. Any questions?
No.
Okay. Well, this Zoom will be recorded and it'll be posted. I say 24 hours, but almost always I get it posted the same night. And the only unknown is how long it takes YouTube to pick it up. And the reason I go through YouTube is they got good closed captioning, and for the ADA, the American Disabilities Act, you have to have closed captioning. So that's why it takes a little bit longer to get it up there. But anyway, this will be posted probably usually like around 11 o'clock. It's usually up. Any questions?
I do, Professor. I just have a question regarding the book.
Yeah.
Do you need like the lab or connection for any so just a straight book, that's it?
Yep. And it can be any form you want. If you can get it in PDF, you can get it in whatever form, it doesn't really matter.
I saw it on Amazon for a little cheaper, and I was just trying to see if we needed the lab or the access to online stuff.
No, you don't need, I mean, there's nothing wrong if you have it, and some people like to use those, they like, you know, the lectures and all that kind of stuff that's in there. But, no, you don't need it. It's not required, I'll put it that way.
Okay, all right, that's the book. Got it.
Any other questions? Yeah, and you know, there's nothing wrong with looking around, see if you can get it for cheaper. And sometimes you can go right through the publisher and get it cheaper than the bookstore. Occasionally by a lot. I'm not sure why, but that's the way it is. Okay, well, I will see you guys in 2 weeks. So we will no class next week, and we'll pick it up. We're gonna do a little bit more of this chapter, but yeah, if you finish up that page, just that quick, I forgot. Problem number
11.
11. Thank you.
I was just looking at it, and it says the excess over the book value is the amount of 30,000. So this is like the previous one we just did, right? It already got the 35% interest. So this is like an excess of 30,000 on top. The second sentence.
Oh, you know what? Actually, when I look at that, we probably should talk about that one. I'm glad you mentioned this. Let's go back to this one, because actually there is a little something I want to talk about here. The total excess is so 420, 370, 30.
So the 50,000 will be the difference, and the excess over the book value, it says.
Yeah.
So it's additional 30,000.
Well, it'll look like this. So this is the purchase for. So the purchase price was 420. The book value was 370. So the total excess was what, 50?
Yes.
Now, what they're saying is that total excess of 50,000. They're saying that a copyright was 30,000 of it.
Mm-hmm.
And that the rest of it was for good. Oops, jumped ahead there. It was 30,000, and the rest of it was for goodwill. So goodwill must be the other, what, 20,000?
Yes. Okay.
So this is what they're telling you. Now, here's the thing. Goodwill just sits there like a lump. It doesn't do anything. So you don't depreciate it or allocate it or anything else. Now this copyright, though, you are going to 5 years.
Right.
Yeah, so this will be divided by 5 years, but this the goodwill we don't do anything with. It'll
Right.
just sit there. It goes right in the books forever, theoretically, anyways.
Okay, so it's the 30,000. Okay.
Yeah. Okay, so, oh yeah. So to answer your question, yes.
Thank you.
It's
Appreciate
kind of a
it.
long
Thank
way
you.
around the barn, but yes, the 30,000 is what you use for the excess.
Okay.
All right.
Thank you very much.
All right. No, thank you. I'm glad you brought that up. Okay. Well, I will see you guys in 2 weeks. If you have any questions, feel free to email me. Next week, I probably won't be answering my email for a while. And if you call my phone, you'll probably get my son. Excuse me. But yeah, so I'll see you guys in 2 weeks, and we'll pick up from there.
Thank you. Good
All right.
luck with the
All right,
surgery.
good luck.
Thank you, Mr. Green.
Thank you.
Have a good night.
Good night.
All right, good night.
Good night.
Good
Thanks.
night.
Have a good night.